We're going to start off with a quick introduction to annuities. There are more videos about annuities a little bit further down, so if you really want to dive into all of the details, take a look at those. As always, we're going to start with the three things that will help you remember exactly what annuities are all about. And those three things are guaranteed income, think mortgage, and security. So who provides annuities? Where do they come from? Annuities are an insurance product. They are provided by the insurance industry. So an advisor like you would be selling an annuity. And the way that they are sold is the client, or typically the annuitant, the client and the annuitant are often the same person, deposits a lump sum into the financial institution. And the financial institution in return agrees to pay a fixed amount at a regular interval. Annuities are a little bit like a mortgage, however, kind of the opposite, because in this case, the client is the one that's giving that lump sum. And so just like with the bank gives you money and then you pay them back at a regular interval over a set period of time. The client gives the financial institution money and the financial institution pays them back over a set period of time at a regular interval. And of course, this does also include interest. So the payments that are returned to the client are a payment of capital and a payment of interest as well. Now, there are two types of annuities, a payout annuity and an accumulation annuity. A payout annuity is one that pays you out or gives an amount back to the client on a regular basis. And there are two different types of payout annuities. A term certain annuity, which like the name sort of suggests, it ends on maturity. Term certain annuities can be provided by banks or insurance companies, and there is an end date. The other type is a lifetime lifetime annuity, which actually never ends. Lifetime annuities can only be provided by insurance companies, and they will pay out until the death of that individual. The other type of annuity is an accumulation annuity. So an accumulation annuity accumulates money. So the client is paying in, but there is no regular payout date until the maturity of the annuity. So the client will regularly deposit money for a set period of time, and then the money is paid out at the end of that period. And actually, a GIC is a type of annuity that is doing just that. Last but not least, we're going to go through some income security. Annuities are extremely secure. They really provide a lot of safety for the client. And so we're going to go through the four big things about that. The income is guaranteed. So the income is guaranteed. There's a life guarantee. There could be a transfer to the spouse, and there could also be a temporary guarantee. So instead of it being guaranteed just for the rest of your life, it could be just guaranteed for 20 years. The annuities are an insurance product, so they are creditor protected as long as there is a named beneficiary. So that named beneficiary can be a spouse, a parent, a child, a grandchild. And as a result, they do also have some protection from probate. Registered annuity has some automatic protections wrapped into it, which we'll discuss a little bit later in another presentation. And then last but not least, as an insurance product, there is assurance protection of 85% of the promised benefit and no less than $2,000 monthly. So there is a lot of security affiliated with annuities. We are going to finish off introduction to annuities with the good and the bad. So there are some advantages as well as some risks with annuities. Some of them we've probably already covered, but we're going to cover them really quickly right here. So advantages. They are very easy to understand. Everybody always sort of gets them. There's not a lot to explain. There is a significant amount of income security associated with annuities. So it's a kind of set and forget situation. You know that you're always going to receive that money for the period that you've set it up for. And there are a lot of income options. So you can receive money for your lifetime. You can set it up to be a spousal income. You can set up a temporary income. So there really is a little bit of flexibility there. Now, there are 3 risks associated with annuities. I'm not going to go into too much detail of their definitions, just sort of give you an idea of how they connect to annuities. So the first is the interest rate risk. So interest rates fluctuate, but the annuity interest rate remains the same. So there is a possibility that you're losing out by being in an annuity and sticking with that set interest rate. It could be lower than what the market is offering. Inflation rate risk. So inflation is increasing every year, as you know, and your annuity interest rate is not increasing. So there is a possibility that you're losing out on that purchasing power as the inflation increases. And the last one is loss of capital, and this is sort of a big one. If there are no guarantees associated with your annuity, then upon death, those payments do stop. And so if there is any money remaining in the annuity, that amount of money is lost. And so that is the loss of capital that potentially is happening when you don't have any guarantees set up on it. So that's everything that we're going to cover in the intro to annuities. We do get into a lot of detail in the next presentation, which is everything that you need to know about annuities, sort of all the ins and outs from chapter 3. So definitely check that one out next.